So welcome back to another video. Today we'll be continuing inventory valuation. And the last time we met, we looked at a few key points and you're seeing them on the screen again today, where we touched that inventory accounting system, what it is, and it speaks to how costs are assigned to inventory. We then looked at the types of inventories and the inventory systems, and we went in depth a little bit. Then we looked at what we considered an important concept, which was the consistency concept, and it spoke about choosing a method, whichever inventory system you want to use, choosing a method and sticking to it, being consistent. So today we have another question, same inventory valuation. It's a more complex question, I'll say. However, if you watch the prior video, you should be able to attempt this question and attempt it successfully. So let's get right into it. So the question that we're seeing here today says, Classiques Design, they're a merchandiser, they have school shoes for girls. So the business began the last quarter of 2013 with 30 pairs of aerosols brand at a total cost of $54,000. So what we're seeing here, this was ending inventory for 2013, right? So it began its last quarter, and quarter is every 4 months, right? So it began the quarter. So the previous quarter that would have been ending inventory, let me correct myself, the beginning of this quarter, this is now beginning inventory, right? And just jumping ahead of myself, we know in our inventory control record system, in our table, that's going to be the first thing that we normally put. What is our beginning inventory? What are we starting this period with, right? So we know where that is going. That's going in our inventory on hand column, and we'll be putting in the necessary information. So below that, we had some transactions that the business completed during the quarter. We'll go through that eventually. Below that, there is some other notes that says all purchases were on account. All purchases are on account. So what this means is that what? This is what they, whenever they purchase goods, it was on credit, right? So this is going to be accounts payable. So every purchase that we conduct or journal entry will be to accounts payable. And this would be a credit to our accounts payable if we were supposed to be doing the journal entries, right? So it says all purchases were on account and received on the date stated, and Classic Designs uses the FIFO method to account for inventory. And we know what the FIFO method is. It says the first set of inventory that you have or that you would have purchased before in selling, it's the first set of inventory that you are going to sell. So what is required of us? Prepare the perpetual inventory record, right, for Classic, to determine the value of ending inventory and the total amount to be assigned to cost of goods sold for the period. And from there, we know we should be able to get that information from our table. The second requirement, given that selling, distribution, and administrative costs for the quarter were the figures there respectively, prepare an income statement for Classics Design for the quarter ended December 31st, 2013. So based on the looks of what we have here, we should be able to complete it. So let's get right into the question. So the first thing that we're starting with is our headings and just laying out our perpetual inventory record sheet or table, if you want to call it. So remember the important details. We can't leave out those, right? Whenever we're doing any statement, any table in accounting, there are headings, and that starts with the name of the business that we're doing this table for. What exactly are we doing? And in this case, the name of the business is Classics Design. What are we doing? The perpetual inventory record, and in brackets, we're using the FIFO method, right? Usually you'd have the date. You can put it here, not so necessary in this table. Followed by that, we have our table headings now, where we have the date, and this is the inventory record system, and it shows the purchases, the cost of goods sold, and the inventory on hand. So those are the three major columns that we'll be having here. So let's go back to the question. So as I was saying before, what usually starts, what's the first thing that goes in our table? Right, or beginning inventory. As long as the business has been operating before, we're always going to be looking for somewhere in the question for beginning inventory. If it's a new business, you wouldn't necessarily have beginning inventory. You might have inventory on hand, yes. It might be opening stock, and that would still go the same place. So here, our beginning inventory, if you read the second sentence, right? In the opening statement, it says the business began the last quarter with 30 pairs of shoes at a total cost of $54,000. So here, we're going to be putting that in our inventory on hand. 30 pairs at a total cost, and the correction here, it's not 153,000, but the correction should be 54,000, right? So it gave us quantity and total cost. So dividing the quantity into our total cost, 30 into 54,000, we know our unit cost, the cost for one shoe is gonna be, one pair of shoe is gonna be $1,800. So that was the 1st of October because that's the last quarter. So let's look at the other transactions. On October 3rd, what happened? We purchased 45 pairs of shoes at a cost of $1,900 each. So this is going in where? Our purchases column, right? And we'll be putting in our purchases column 45, the quantity, unit cost each, $1,900, and multiplying those, we get our total cost. And then we then update our inventory on hand. We look back at what we have left from the previous date or period, and then now we add what we just purchased. So our inventory on hand at the end of this day, we have 30 sets for $1,800 and 45 sets for $1,900. That gives us a total cost, which is $54,000 plus $85,500, $139,500. Moving on. So on October 15th, we sold 55 pairs to Casually Elegant Limited at a unit price of $2,780. So what did we say before? This unit price, this is what? Our selling price. So yes, we know for sales, it goes to our cost of goods sold. But the unit price that we would have been given in the question is not important to a perpetual inventory record system. What is important? Going back to the question, right? Looking before this transaction, what was our inventory on hand? That is what we'll be using to populate our cost of goods sold table. Point to note, we would have still sold 55 pairs. But how we'll be representing that in our cost of goods sold section is dependent on our inventory on hand. And what I mean by that, we're doing the FIFO method. The FIFO method says the first set of goods that you have in your stock is the first set of goods that should go out in a sale. So we sold 55 pairs of shoes. The first set of goods that we have is a set with 30 that cost us $1,800 each. Honoring this concept, what we have to do, we have to sell from that 30 first. But we sold 55, so we need 25 more. So what we then do, we go to the next set of goods that we have, and we take 25 pairs from that. Note, here we have two different unit costs. Why? We have to keep the unit cost from where we took it. You're not going to be putting the price that you sold it for, right? Last week we said the price that you sold it for, that's the selling price, and that goes in our income statement. So the price that we're using here is the cost. What did it cost us to sell these goods, right? So here we would have done our multiply 30 by 18, then multiply 25 by 1900, add those, and the total cost to sell this good was 101,500. What we need to do next is to update our inventory on hand. So we would have only taken out 25 from the set of 45. So we would have been left with 20 pairs at a unit cost of $1,900, and the total cost there being $38,000. Let's look at October 26. So October 26 says we purchased 70 pairs at a cost of $2,400 each, but these were subject to a trade discount of 5%. What does that mean? Well, what it means is you got a discount, right? So the price that we're seeing here is not the actual price that we paid. It's the cost for it, but we got a 5% discount. So what we have to do is to find 5% of the 2,400. That gives us $120. Then we subtract that from 2,400 and we would have gotten 2,280. Another way to do it is simply to find 95% of the 2,400. My math brains would understand that. But we found the discount and we found the new price that we have now purchased these 70 pairs of shoes for. So under our purchases column, we're going to have 70 pairs at 2,280. Multiplying that, we get our total cost, 159,800. The usual, we need to update our inventory on hand and to find the total cost. So let's look at November 10th. On November 10th, we sold 60 pairs to Best City Store, which yielded total sales revenue of $192,000. This question, same as October 15. The difference is it gave you total revenue, it didn't give you the unit selling price. And as per usual, this sales revenue, this selling price, it's not the focus for our inventory record system. So what we need to pay close attention to is how many pairs of shoes did we sell, right? And that's 60. So we go back and we look, okay, what was our inventory on hand? What's the first? And that's where we're pulling from. So we have to take the first set of goods that we have there. That's the 20 at 1,900. We sold 60. So we need to pull 40 from the 70 that we have there to make it the 60, right? Updating our inventory on hand, we're now left with 30. That costs us 2,280, which gives us a total of 68,400. You may ask, so we sell 60, why we couldn't just take the 60 from the 70, right? Easier. But remember, the method that you're using is the first in, first out. So at all times, you should be first using up the first set of goods that you have in your inventory that is available. So let's continue. So that was November 10th, November 14th. So owing to an increased demand for this brand, nice, the manager of Classique purchased 80 additional pairs at a unit cost of $2,500. But additionally, there was a freight charge of $100 on each pair. So we have two sets of information here. We have the cost for the shoes to purchase them, which is $2,500, and we have a freight charge on each shoes, right? So what do you think? If you own a business, right? And you're a merchandiser, you're just buying to resell. And the cost for the product that you're gonna resell is 2,500. But you know you have to pay shipping and handling, etc. How would you go about selling that good? And what would you consider? I don't want to give it away, but I am. What would you consider your total cost for the shoes or this item? Right? The total cost for the item is going to be the 2,500 plus the $100. So we're seeing here where the actual unit cost for each pair of shoes is not just going to be 2,500, but 2,600. So this is a purchase. So under our purchasing section, we're going to have the 80 pairs, the unit cost 2,600, right? We get our total cost and we update our inventory on hand, bringing back what we had before and adding what we just purchased. So let's continue. So on November 24th, we sold 60 pairs of shoes to Big Buy Company at a purchase price of 3,600 each. So remember, for a sale, yes, that's going to our cost of goods sold section. But to update our inventory record system, all we need to really focus on is what was the quantity sold. And the quantity here is 60. So using the method, we pull first from what the first set of inventory that we have. That's the 30. But we sold 60, so we need to take another 30 from the second set, right? Summing those, then we have to update our inventory on hand to 50 at 2,600, and we get our total cost right there. So on November 30th, so a physical stock count on that date, November 30, revealed that there were 42 pairs of shoes in the warehouse. Okay, so let's look back. If we're supposed to look at our inventory on hand, right? Because that tells us at any particular time what the system is saying that we should have. So we're seeing here where it says 50, right? But the question says you did an actual stock count. You actually went into the warehouse and counted each box, and you only got 42. So something here is wrong, right? What your system is saying or what your filing is saying, oh, we should have 50, man. But when you actually went there, you had 42. So for whatever reason, 8 pairs of shoes is unaccounted for. In accounting, you can't leave it. You can't leave it at 50 when you have 48. You'd be overstating your inventory, you'd be overstating your assets. So therefore, we now need to what? We need to correct the system for it to say, okay, we have 42 pairs of shoes and not 50. So how do we go about that? We have to correct it on the perpetual inventory record system. So how would we go about correcting that? So looking at our table, it wouldn't be a purchase. A purchase would mean you're adding, right? Additional goods coming in. Cost of goods sold is used when goods are coming out for sale. Then you have inventory on hand. That we can't do much tweaking to. So the best option here is our cost of goods sold, because we can assume maybe it was actually sold and the system wasn't updated, or unfortunately, it was stolen. If it were stolen or if it was sold, it's gonna cost the business. So hence, the best column to put this under to make this correction is our cost of goods sold. So that difference of 8, we're gonna put it in our cost of goods sold. Just having it there, whether or not it was sold or stolen, is still a cost to the business, right? So it's 8 at the unit price, 2,600, and we have a total cost there. Now our inventory on hand is saying what we actually went and count and got 42 pairs of shoes. So I know that one might be a little bit challenging, but think about it a little bit more. So on December 4th, this was a purchase. He purchased 75 pairs of shoes for a total cost. So here he gave us the total cost, not a biggie. What we do is divide our quantity into our total cost and we get the unit cost. So that goes under our purchases column. And now we update our inventory on hand. All right. So December 15th. So what December 15th is saying is that 5 pairs of shoes purchased on December 4th were returned to the supplier as they were of the wrong description. So if you go back to December 4th, right, you purchased 75 pairs of shoes. But what you're saying is on December 15th, you returned 5 of these shoes that you purchased. So what do you think we're going to be doing here? We have to decrease our purchases. We have to decrease our purchases by 5, and we have to update our inventory on hand because we would no longer have 75 at the 2,850, but 70. So first, we have to decrease our purchases. And in accounting, we show that we're subtracting by putting figures in brackets, right? So this 5, to reduce purchases, we have to go back to our purchases column, put 5 at the price that we purchased it at, find the total cost there, putting it in brackets, right? Pardon me. Then we go to our inventory on hand. We're keeping the 42 at 2,600. However, it's no longer 75 at 2,850, but 70 at 2,850, and we have our total cost there. So on December 30th, we sold 70 pairs, right? That's a unit selling price of 4,400. We go back to our last transaction and we look at our inventory on hand. Whoa, well, we have a set of 70. We can just give him that. Can we? No. We have to follow the principle of first in, first out. The set with 70 is not the first set of goods that we had in. It was actually the last set of goods that we purchased. So first we have to take from the first set that is in, which is the 42, and the balance we take from the 70, right? We find the total cost for that, and at the same time, we update our inventory on hand. So the next statement is just a little bit of information. So we have no more transactions to put in our perpetual inventory system. So now we can close it off by summing the various columns. So we come to our purchases, add all the quantity, remember, noting this 5 in brackets should be subtracted, right? We do the same for total cost, noting this 14,250 should be subtracted. We go over to our cost of goods sold and we add our quantity, adding this 8 as well. We do the same thing for total cost, adding this 8. As per usual, our inventory on hand, this would have been already updated. So now we know, the question asks us, what's our inventory, the figure. So this is what the figure that we have for inventory. And it asks us for the value of cost of goods sold. So this would be our cost of goods sold value, right? So part 2, we're supposed to prepare the income statement given these additional information. And these additional information our expenses. And these would be going after we would have found gross profit. So this is what our income statement would look like, right? So you have the name of the company, what are we doing, the income statement, and the period. Our income statement, you can look at our other videos where we spoke about what is in our income statement essentially. And here we have sales. And this sales figure, if we want to go back, sorry, to look at the question, this is where all these prices that were in the question about unit price and sales revenue and each price that you sold it at, this is where these come in handy. So if you're supposed to go back, all these prices that you're seeing here, that we're showing you how we got our sales price to be 8,600, 868,900. So adding those gives us that. Our cost of goods sold, we say, comes from our perpetual inventory records table. This figure here, that's what goes there. Subtract that from our sales, we get our cost of goods sold. Then from that, we subtract all our operating expenses, which are these additional information that they gave us. We subtract those from our gross profit, and we would have gotten our net profit. So answering all the requirements for this question, we've successfully satisfied all of that. So this question here is finished, right? And as I said, if you had watched the prior video, you should have successfully completed this with just probably the 2 additional surprises, I would say, that we have. So remember to like this video, share it with someone, subscribe to our channel, and leave a comment below. As per usual, you can reach out to us via email or our Instagram page. So until next time for a question, enjoy the rest of your day.